Hello, everyone. In this video, I will walk through the assignments 2, which is income statement projections for Apple. So since I already provide you with the guidance file, let's just follow the steps that I provided to solve this assignments. So in this assignment, complete all highlight cells in provide Excel file by following steps below. So this is the Excel file that I provided, and basically we will just work on the projections for the income statements of Apple for the next 5 years. And there are two tabs you have to work on. One is for the model assumptions, the other one is for the actual income statements. So we'll get started here. First step, let's calculating the historical sales growth rate. I give you the formulas there. So basically, we just have to apply this formula for the product sales, service sales, and the total net sales for the given years. And then we just move on to the model assumption tab here and start our calculation. So here we're going to calculating the simple growth rate, basically using the ending year divided by beginning year sales and then minus 1. So this is equal to, we go back here, find 2018 product sales divided by 2017 product sales and minus 1. This gives us 14.9%. This means from 2017 to 2018, the product sales went up by 14.9%. And then we do the same calculation for services. So this is equal to, we go back to income statements using 18 service sales divided by 17 service sales minus 1. This gives us the growth rate. And then for the total sales growth rate, that's using the total net sales for 2018 divided by 17 and minus 1. And then we can basically just highlight this whole sections for historical years and fill right, and you should get a general idea. Again, the reason we're doing this step is like you still can find some guidance online. If the company provides you with the guidance of their projections on the next several years sales, you should use that directly because that's directly coming from the company. Sometimes, or most in the scenario, we don't have a guidance provided by the company. Then we do need to find other resources and other financial analyst assumptions or projections for future sales. You can get started with that, or you can even just assess the historical sales and try to make assumptions based on the historical trend. Maybe we see there is a clear increasing trend, then we can get started to using or follow the same trend unless you have other guidance provided companies to project the future year sales. Okay. So for our assumptions here, assignments here, I said estimate the future sales growth rate. We used the method that provided by the book. We go to Yahoo Finance because this is a free resource. You can get a financial analyst consensus for their estimate for 2024 and 2025. And then we will input those projections and then assume the growth rate is going to remain the same starting from 26 to 28 as 2025. So I already got the Yahoo Finance pull up. What we can do here, we can just go there, search for Apple. And then we can click the analysis on the left side. And scroll down a little bit, we will have the revenue estimate sections here. And on the bottom here, we see that based on 40 financial analyst coverage, they projected the next year, the sales, Apple are going to grow the sales by 9%, and then 25 going to grow by 8%. Okay. So what we can do here, we're going to just go back to our assumptions, and then let's just hard code it for 2024. Financial analysts project 9%, 2025 is 8%, and we assume this 8% gonna remain the same for further 3 years. Okay. And then once we have this projected sales growth rate, now we can project the total sales for next 5 years based on the formulas here. If you have the estimated growth rate, you already given the previous year sales, that's the actual number from 2023 filings. And then we can just basically calculating those, use this formula. So we can go back here to the income statements. That's just calculating the total net sales by using previous year multiplied by 1 plus, don't forget, use the parentheses here. 1 plus 9%, close the parentheses, we get the sales calculated. And since we know that for the following years, we're going to use the same formula, and this setup, the model setup is exactly the same as the model assumption set tab. So what we can do here, we can just highlight the entire row and go ahead and fill the formulas to the right. Now we got the total sales calculated or projected for the next 5 years. Then we'll move on to next section, cost of sales. So based on the guidance file I give you, first, we're going to assess the cost of sales as a percentage of total sales for the past 5 years. So what we can do here, let's go back to this model assumption tab. Let's just go ahead calculating what is the cost of sales as a percentage of total net sales in the past actually 7 years. So we go back, this is equal to total cost of sales. Let me go back here. Yeah, we just using the total cost of sales. So we'll ignore the segment cost of sales. So this is equal to total cost of sales and divided by sales. Okay. And then we can just go ahead and fill the formula to the right. So what does 61.5% mean? Basically, that means once the company generates the sales, 61.5% of sales goes into the cost of sales. It's going to cost you this much and to make that sales. Okay. And again, the reason we're doing this is we do need to find some sort of guidance or some implied informations to make a future assumptions. So you can assess this trend. Apparently, we see that Apple managed to control their cost efficiently, like in the past several years. So therefore, we see there is a declining trend for this cost of sales as a percentage of sales. And make sure that to remind yourself, you understand the concept of this percentage, okay? So this is cost of sales as a percentage of sales. Even though we see there's a declining trend, it doesn't mean that cost of sales gonna decline in the actual value or absolute value. It's just like in the relative value as a percentage of sales, you do see a declining trend. So meaning that if the future years, the sales gonna be up and you may see the cost of sales also going up. But when you're calculating the cost of sales as a percentage of sales, you do see a declining trend there, okay? Let's go back here to the guidance file. So what we do here, once we have the values here, and we're going to use a method, all of that 7 method we discussed in the class and also discuss in the book. So we use the average functions to calculating historical average cost of sales as percentage of total sales. Use that for 2024 projection. So what do we do here? We do an average, and then let's take an average of this. And for this assignment, it's basically just help you to practice the contents we discuss in class, okay? And apparently, if this is your analysis, you see there's increasing trend from 17 to 19, and then starting to see gradually decreasing, then it's reasonable you make assumptions that we're going to see continue declining trend for the future projections. So you can project that it's going to decrease by like a 0.5% every year, year over year, or you can use the most recent year as a guidance because that's the lowest one. So here, I just provide you another method. You can take an average. It doesn't mean you have to use the average method for your own analysis, okay? So we use the average. That means like we project 2024, this cost of sales is going to have 59.7% for total net sales. And if we go back here, the question says like we're going to input that for model assumptions tab for 2024 and then straight line that from 25 to 28, meaning that we're going to just keep this the same. So you don't copy the formulas, because if you copy the formula from this cell to this cell, then you click the cell, you're going to realize, okay, basically you're going to continue calculating average for the past 7 years. Okay, that's not what we want, or at least that's not provided by the guidance. So we're going to streamline that. You're just going to simply just link that to the previous year. You click this, we're going to link that to previous year. And then once you make any changes, all the future years will automatically change. Okay. Once we have this, apparently, if you go back to the guidance file, I showed you that once you have the percentage, you should be able to calculating the actual value for cost of sales. You just back solve that. So we have the percentage here. Now we do have the projected sales from the first, the early steps. Then what we can do here, we can just use the projected sales multiplied by the projected percentage here. And we can copy the formula, then we get the cost of sales. Now we can calculating gross profits by using net sales minus cost of sales. And then we can go ahead fill right. Once we got this done, we can come back to recalculating the gross profit margin. So gross profit margin is equal to your gross profit divided by net sales. And you can just go ahead, fill right all the way down. Okay, so what's the reason we need to calculate in this row? If you recall that from step 1 or the first assignments, well, first part of our financial modeling course, you should remember that actually in the first part, when we conduct the historical financial analysis, we already assessed the past gross profit margin. So I would say here at this step is not necessary to do this, but sometimes people like to do this way is maybe you don't have a guidance on the cost of sales as percentage of sales. But maybe the company is going to give you a guidance as like in the next 5 years, we project that we're going to be able to maintain the same gross profit margin for the next 5 years. Then that means like you do need to know that how you're going to be able to back solve this cost of sales. If let's say the company give you a guidance says like next year we're going to maintain this as the same as 2023, so that would be a 44.1%. So then what's that mean? That means you already have a projected gross profit margin. So what you can do here, you can actually come back here to solve your gross profit first, and then use your net sales, subtract your gross profit. You will end up with the projected cost of sales. There are always going to be many different ways to solve this. Depends on your assumptions, depends on your research, and depends on the guidance that you get from the company. Okay, we're going to continue doing the way that I showed you here. We solve this cost of sales, and then we back solve this gross profit margin based on our projection for net sales and the cost of sales, because that's provided by the guidance. At least in the exam, you will have similar guidance there to ask you to solve certain things in a certain way. You just have to follow the guidance. Okay. Now we have this part done. We continue our calculations here. Next step, we're going to calculating R&D, SG&A as a percentage of sales. And first we calculate the historical percentage. So for this one, that's just equal to R&D and divided by sales. And starting from here, you know, like whenever you divide it by the same thing or multiply by the same thing, you should remind yourself there are easier way or faster way to do this. So we know that for sure for next one, SG&A, we're going to divide it by the same thing, which is net sales. So that means if we can anchor our denominator for this R&D divided by net sales at a certain way, and then we can just copy that formula down. Okay. So let me just hit enter here. If you click that, you see that we use R&D and divide by net sales. And we know that for sure next one, the SG&A, we're going to divide it by the same thing, which is the E10 from previous tab. So let's come back here for this denominator. We can just anchor this. If you anchor this once or lock this once, you see $2 signs here. This means we're going to lock both the column and the rows. We don't want to lock the rows because, we don't want to lock the column because different years, the sales is going to be different. If you lock the column, it will always grab the 2017 sales. That's not what we want. So we're going to anchor this one more time. Now we don't have dollar sign in front of E, which means we will let the column change, but we will block this row, which is row 10. That's your net sales. This is exactly what we want. If we lock this way, then we can basically just highlight this row all the way to 23, and then also the next row, and we can fill right, fill down. Double check whenever you do a shortcut calculations in Excel. Let's check this one. So this is equal to J18 divided by J10. So that will be 2022 SG&A. So let's go back here. J, there will be this column. J18, that's what we want. We want to calculate SG&A divided by J10, which is total net sales. That's exactly what we want. Okay, so now we done this. Historical assessment. Again, the reason we're doing this, we want to assess the historical trend. Clearly, we see that Apple continue to invest money into the R&D, which makes sense because for all the tech companies, they do need to invest significantly amount of money to keep their product updated, or they have to design a new version product to be able to maintain their leading position. Okay. And for SG&A, it seems like a pretty like standard or constant in the past years. So let's take a look for the guidance file. So for R&D, what are we going to do here? We're going to assume R&D going to remain the same as it was in 2023 from 24 to 28. For SG&A, we're going to calculating the historical average. Then it's going to remain the same. Okay. So R&D, we're going to remain the same for future years. For SG&A, we took an average for all of the historical years, and then we're going to straight line that for we're going to straight line. Oh, I'm sorry. We're going to streamline this for future years. Okay. Again, this assignments just help you to practice the contents we discuss in class. When you make assumptions, you do need to connect this assumption part with companies' filings, with your own research, and you need to link back to your part one analysis, which is those qualitative analysis based on your assessments for the current economic conditions, current industrial conditions, current competitive positions in the same industries. You will end up with different assumptions. Okay, so once we have this done, we're basically going to do exactly the same thing as the cost of sales calculations. We know that when we calculate the percentage, we divide it by the sales. Now, what we need to do to solve these values in the income statements, we just need to use this percentage multiplied by the projected sales. So let's going back here. We do the same thing. We're going to multiply back the same thing, which is net sales. So what we can do here, let's just choose the cell and anchor the row. And then we know that for sure we're going to be able to copy this, okay? And use that multiply by this percentage. You don't have to lock anything for the percentage because it will change year over year. And apparently if you change to different rows, it should change to different rows. Once we get this done, you can highlight this field right, field down, which if you do the Command R, Command D, you're going to get the job done, but you're going to lose the original, like the model setup or templates here, meaning that you're going to lose this like underlines for this row. So what we can do here, we can actually just copy and highlight the both rows. You can paste the special. Let's just paste the formula and the number formatting. Clearly, there are keyboard shortcuts, but I would say you're not going to be able to see my shortcuts there. So I'm going to just use the mouse here. Okay. Once we're done, again, double check sale. Let's pick the last one here. This is equal to sales. Basically, this is right. Multiply by P16. Let's go to the model, find the P16, which is the percentage, this one. This is P16. So that is correct. Now we can go ahead and solve what is operating expenses. We can just take a sum of these two rows. They give you the total operating expenses projected for next 5 years. And then how about EBITDA? For Apple's EBITDA is a little bit tricky calculation. So apparently we don't have enough information to construct the separate depreciation schedule. So actually I showed you, or in the guidance file, I showed you another way you can estimate the depreciation. But what we can do here is we know that we already got the gross profit, we got our operating expenses. So you can actually go ahead calculating what is the EBIT, what is your operating income. So that will be gross profits minus your total operating expenses, and you will get your EBIT. And now we can just like project the D&A and then back solve what is the depreciation EBITDA. Okay, so let's go back to the guidance file here for the historical depreciation. What we're going to do, we're going to be similar steps for R&D, SG&A. We're calculating historical percentage of total sales. So in my lecture file, I showed you that if you follow by our book, and if you do have certain information, we already done that for the Amazon, so you know that if the company provide you with guidance on the, like the depreciation method they're using for Amazon, they're using Streetline. If the company give you a certain level of the information, like the useful life, we saw that for Amazon, then I would recommend it to construct the depreciation schedule. So they will give you a more reliable estimation, I would say, or approximation. It doesn't matter which method you use. It's just it will be approximation. Even though for Amazon, we did a depreciation schedule, still we're trying to approximate what is the depreciation could be in the future. No one knows what's going to happen in the future, okay? But there are other ways. If you don't have that information, or if you want to keep your job a little bit easier, simpler, you can project D&A as a percentage of sales. But I will recommend it if this is your Tesla project. Definitely for Tesla, you do have the information. You need to construct the depreciation schedule, or you can estimate the depreciation as a percentage of net fixed asset. If you do that way, that means like whatever you projected on the cash flow statement for your capital expenditure, this D&A will directly change associated with the change of those capital expenditure. If you project it as percent of sales, sometimes you see a little bit discrepancies there, okay? But I'm not saying this is wrong. This is definitely one out of many options that you have to project depreciation. So now we're gonna just calculate the percentage and assume it's remain the same. Then we come back here. find the model assumptions. Let's calculate what is the depreciation as a percentage of sales. So that will be D&A divided by total net sales. And we can just go ahead, fill right. And our guidance file from the assignments says that's going to remain the same. Then let's just remain the same. Okay. Once we have this done, since we're calculating this percentage as a percentage of net sales, meaning that when we come back to calculating this D&A for the projected year, that's going to just equal to the projected sales, and projected sales multiplied by your projected percentage. And then we get this done. Once we have this done, we can back solve EBITDA. Basically, from EBIT to EBITDA, you're just adding back D&A. So that will be a D&A plus EBIT. You get your EBITDA projected for next 5 years. Okay, so, and a lot of time, like I said that in class, it's better you set up your model first, and then you can come back to tweak your model. So apparently, based on our projections, you take a look, you're going to realize that, okay, based on our assumptions, EBIT are going to decrease from 23 to 2024. Is this reasonable? Or there are some things that we need to make adjustment? So that's where you should starting to ask more questions, starting to tweak your assumptions, make more reasonable assumptions, or make more reasonable adjustments to make your model more reasonable. Okay. So once we get this done, what we can do here, we can come back to solve the EBITDA margin and the EBIT margin. So EBITDA margin going to just equal to EBITDA divided by net sales. And you can just go ahead and fill this right all the way. And again, as I said, for this assumption part, you don't really have to calculating this, but maybe you get the guidance, or you get some research from other financial analysts. They project the next year's the EBIT are going to be the same as this one, or going to be in line with like an average for past 3 years. Then clearly, based on our model, our EBIT are going to be 28.9%, which is like a 3% lower than the previous year, roughly speaking, 4%. So you're going to ask questions, or are going to compare your research with other financial analyst research or companies' guidance to get a better idea of what would be the reasonable assumptions there. Okay. So let's continue. Oh, we get calculating the EBIT margin. That's just equal to your EBIT divided by net sales. And again, we can just go ahead and fill right. Okay. Then continue our guidance file. Project the other income. Assume other income remain the same as 2023 from 24 to 28. So we come back here. Let's just link this in the model assumption tab. Link this to the previous year other income. So as we discussed in class for the, So you see, if you just go ahead and fill right, copy the formulas, you're going to end up with 0. But what we actually want in the guidance file is we're going to keep the same. So you actually, for 25, you have to link to 2024. The only value you link back to the income statement will be 2024. So technically speaking, this should be black color because this is not linking from other sheet. Only this one is linking from other sheet. If we come back here, if you recall that in the Amazon example, actually there are many ways to project this other income. There are 7 methods. It depends on, you do need to perform like keyword search from 10K, 10Q, see if you have better information about this. I mentioned that in class, don't be too hard on yourself on this one because this will not go into the final valuations. This is other income, everything below EBITDA, that will be the income is actually not related to their core business. Eventually will not affect our valuations. So based on the book, you assess the historical information. This is also going to be affected by how many historical years you collected for your model. My Apple assignments here, I gave you the past 7 years. In the Tesla project, you gather 5 years. For Amazon examples, you only get 3 years. So even for 7 years, you see there's no clear patterns there. So follow by the book, out of 7 methods, you can try to assess the information and then just take a minimum, be aggressive. Or technically speaking, if this is other income, you can take a maximum to be, what we did here is actually we list out the income as negative value. So I would say, yeah, if you took the minimum one out of this case, that would be more aggressive method. If you take a maximum one, that will be a more conservative method. You can also take an average and you can study the historical trend, use the trend analysis. You can streamline from the previous year, and there's at least the 7 method introduced by the book. So our examples here, we're going to just streamline that from the 2023. And then what we do here, let's just link back from your assumption model assumption tab to get all the other income projected. Next, we can interest income is coming from the debt schedule. So we're gonna leave it blank for now, but we're gonna continue our calculations here, meaning that we're gonna just take the sum of these two to get the total interest expense. The reason we keep the calculations here on the income statements or any other financial statement is because like once we've done the projections for debt, this value will automatically pop up in our model. So you don't have to go back and forth, keep changing things. You just have to link the necessary sales in your calculations, and then eventually you just need to input or link that resource once in your model, and everything else will be automatically pop up. So then the EBITDA is gonna the earning before tax is gonna be EBIT. We're gonna subtract this other income and then subtract this total interest. The reason we use subtractions here is because, again, I list out the format of my historical financial statements. I keep everything, all the expenses positive. And then when I'm calculating those totals, we basically just subtract that. I know this row is called other income, but we do the same thing. We list out this is positive, meaning this is other expense. This is negative, this is actually the income. So when we're calculating this earning before tax, we technically speaking, we subtract this negative value. So we're adding that back mathematically because this is the income. Okay. Now we got this part done. We just continue our calculations. Next, we move to the income tax expenses. So let's go back to the guidance file, take a look for income tax. Assume the tax rate to remain constant at the 23 level from 24 to 28. So we need to first calculating the tax rate or effective tax rate using the income tax divided by earning before tax, and then streamline that. And then eventually we just back solve the income tax by using the estimated tax rate multiplied by estimated earning before tax. So if we switch back here, we already got the earning before tax calculated. So first, let's go do the model assumptions. Oh, let's finish this one first, since we already done the taxable earning before tax calculated. So let's just go back, find earning before tax, use that divided by total net sales. This will give you the EBT margin, and we can just go ahead and fill right. And then next one, let's calculating the effective tax rate. That's going to equal to the income expenses, tax expenses divided by earning before tax. So if we go ahead for right, you see clearly the company's tax rate, effective tax rate changes year over year. It may impacted by the different tax code that introduced by different administrations, governments, and at the same time, Apple, a lot of companies, there are public companies, there are multinational companies, their tax expenses also affected by wherever the local government's tax code is or tax policy is. So that's why you see that even though after 2017 with that Job Act and Tax Cut, Job and Tax Cut Act came out, the U.S. corporate tax rate is flat out at 21%, but still a lot of big companies, they do pay less taxes because a lot of their income is coming from overseas, other countries, so they pay tax differently in different countries. So our assumptions or our guidance file says we're gonna remain the same for future years. And then let's come back here. We already project the earning before tax. And then what is the tax rate? The actual taxes. That's just the earning before tax multiplied by how much percentage is going to be tax away. And then we get the tax calculated. And then we can just using the earning before tax, subtract tax, that gives you the after tax earning, which is the net income. Okay. So once we have the net income, let's come back to solve this net profit margin. That's just equal to net income divided by net sales and 21%. This is also going to be a good point to check or compare your result or projections with the other financial analysts. If you do have the access to other resources, you may find out like some financial analysts that they cover that they project the EBITDA margin going to remain the same or higher. Yours, mine is like way, not way, but it's still lower than the previous year. So that may give me some idea that probably I should make an adjustment to match what other people's believe. And again, remember that for this financial model is approximation. So even though you use other people's like a research as a guidance, which is also fine, because eventually you can still set up your like scenario analysis, sensitivity analysis. What if they're wrong? You can change certain factors into model to see how that's going to impact your valuation, which going to be impacted on your have an impact on your investment decision. Okay. So once we get this done, the only thing left will be the shares outstanding and the earning per share. So as I mentioned previously in our class, you do need to calculating those earning per shares for both basic and diluted shares, meaning that you already get income, net income, and you're gonna make a projections for those shares outstanding. Then you just use the net income divided by shares outstanding. You should be able to solve or back solve those earning per share. Okay. So for our examples here for Apple, there are many ways to gather those like future years projections on the shares outstanding. So what I recommend is use the admin ESEC to find the most recent 10Q, which is would be Q3. Locate the basic and diluted share outstanding as January 29th, which is 9 month ended. That's input those values and straight line that for the future years. Okay. So meaning that what we're gonna do here, we're gonna go to admin SEC. Let's just go ahead, search for Apple. Let's find the 10Q, Q3. So one way to find, like the basic shares outstanding, you can check the first page for 10Q or 10K. And at the very bottom of first page, normally they will give you the basic shares outstanding as of that 10Q is filing. So this is one way to get the basic shares. And of course, if you use this way, then you do need to search the notes from the 10K or 10Q, see what's other things provided. Basically, the differences between the basic shares and the diluted shares, you just have to check, see if company issue any like a restricted stocks or stock options going to be eventually or potentially be converted to common stocks at a certain point. So you just need to adding those back to get the diluted shares. What we can do here for our assignments here, so I ask you to take an easy way. Let's find the financial statements, specific income statements. So you see that we do have a 3 months ended as basic and diluted shares, and then we also have a 9 month ended. So let's just grab these two. So for 2024, we're going to use this values as the projections for 2024 dilute the basic shares outstanding. Let's just make it a little bit, oh, I'm sorry. Make it a little bit wider. And then for the diluted share, we do the same thing. Let's go find the diluted shares. And from our guidance file, we're going to just keep this remain the same. And sometimes you see they give you all those like a hashtag or a pound signs. It's just because your column is not wide enough. You can just manually widen that, or you can just highlight the column and double click the side. It will widen the columns for you. Okay. So once we have those shares, we can come back and then starting to link those numbers. And if we do fill right, fill down, you're gonna realize you see we lose this like underline or the lines below this last row. So instead of doing that, what we can do here, let me just write this. We already linked this one. So let's just copy, Control C, and then let's just paste the formula and number formatting. Oh, I'm sorry. We're gonna highlight this two rows. and paste and formula and the number formatting. Okay, same idea. Let's just make this wider. Then you get your number linked, and you see that I don't mess up with my templates here. Now we can just back solve. What is the basic shares? That's going to equal to net income. I'm going to just take an easier way because I'm going to use the same numerator to calculating the diluted share earning per share as well, because that's going to be the same thing, net income divided by different shares outstanding. So I'm going to just anchor the row here and then divide it by shares outstanding for the basic shares. And then what we can do here, we can just go ahead, fill right, fill down. You get your number in. Okay. But if we take a look here, we're going to realize apparently this number, every time, don't assume that once you've done the calculation, you're done. You do need to do a due diligence to check whether the number you came up makes sense or not. Apparently, this number looks way different from the historical earning per share. So this should like raise alarm. You got to go back to check what's going on, what things we did wrong. So normally, if you see things like this, it may caused by the just the unit of the figure that you use in our financial statements. So that's where you have to check. Apparently, for our models here, we see that everything reflected here on the income statements will be in US dollar in millions, except the number of shares, which are reflected in thousands. So that means the unit of figures for this net income is different because this is denominated in millions, but the shares we plug in is denominated in thousands. You have to also double check, go back to the 10K filings, and normally they will give you the same information just below the title of that financial statements. So here on the income statements, everything is in millions except the number of shares, which reflected in thousands. So that means we do need to convert our shares outstanding in thousands to in millions. Okay. So clearly I use the formulas here for the previous earning per share calculations. I basically just use this shares outstanding divided by 1,000 for my numerator. Oh, actually I multiply by 1,000. So basically I'm going to come back here. Let's just redo that. So we know that you either have to change this net income denominated in thousands or change this denominated in millions. So basically, in the past, my calculation just changed the net income. I'm going to do the same thing. So net income, let's anchor the row, not the column, and use that multiply by 1,000. Doing this, we know that we're going to convert this net income denominated in millions now, in thousands now, not in millions. Okay, use that divided by shares outstanding, we get the number. So now we can fill right, fill down. So now the number is more reasonable. But again, you do need to justify your assumptions here. Apparently, based on all of our assumptions that we made for the model, we end up with the earning per share, which is lower than the previous year. So technically speaking, we do need to find some support or evidence that shows us maybe 10K or the guidance file or the earning cost that the management mentioned that there are some pressures for their like iPhone sales, which gonna cost, maybe we're gonna see a slightly decreasing earning per shares or profits next year, something like that. Otherwise, you do need to maybe go back to check what is other financial analyst projections. Apparently, ours is going to be decreasing from previous year, which probably doesn't make much sense. But again, it really depends on your own research. So make sure that for a Tesla project and even your final group project, make sure that your model gonna live on some reasonable assumptions, which gonna, like people gonna ask questions whenever they see your model, why the EBITDA you projected is lower than previous year, why everything else are below earning per share, the bottom line is below the last year's. What happened? What's gonna happen based on our assumptions? Okay. But this will be the solutions for this assignments. I hope this helps. Let me know if you have any questions. Okay. Bye.